Today, poles apart. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 1st of September 2018, our digest of the latest finance and property news with a distinctively Australian flavour. Locally, the bad news keeps coming whilst US markets remain on the boil. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. Here is the link, and it's also in the comments below. 9 News published an article this week claiming that Sydney and Melbourne dwelling values may soon rise again because of a decline in dwelling construction, citing a report saying that the rate of construction is expected to slow down, with the number of new homes built set to fall by up to 50,000 each year. So they say that would mean 20,000 fewer homes built across the country each year than the 195,000 needed to meet future demand. And indeed, the ABS reported this week that building approvals in July were 5.6% lower than the same time last year. Total seasonally adjusted dwelling approvals in July fell in New South Wales by 5.2%, Victoria 4.6%, Queensland 6%, South Australia 26.5%, and Western Australia 14.7%. Seasonally adjusted approvals increased in Tasmania by 13.6%, and in trend terms, total dwelling approvals in July increased by 4.5% in the Northern Territory and in the ACT at 12.2%. The data shows it's high-rise apartments which are falling the fastest, in response, of course, to slowing demand from investors. But it's worth noting that the volume of approvals for new detached houses has been tracking around their strongest levels in 15 years. The HIA said that weaker conditions in a number of states have typically been overshadowed by strong activity in Victoria. With Victorian home approvals now showing signs of weakness, they expect the national trend of declining building approvals will continue throughout 2018. And the HIA also reported on new home sales for July, saying that consistent with the trend for much of 2018, July saw sales fall by 3.1% compared with the previous month. Sales in 2018 thus far are 6.1% lower than in the corresponding time in 2017. The noticeable new trend is that new home sales in Victoria are weakening. And Victoria has experienced exceptionally strong conditions, which have been sustained over a number of years, obscuring weaker conditions in a number of other states. With Victorian new home sales now showing signs of weakness, they expect the national trend of declining sales will continue throughout 2018. And the Sydney market has also been cooling throughout the year, particularly in the new growth areas. The high volume of new apartments in metropolitan cities are competing for first-time buyers and resulting in a slowdown in new detached home sales. Other regions in New South Wales, such as the Hunter, around the ACT and South and North coasts, are continuing to see stronger growth. They say the market for new home sales across the country is cooling for a number of reasons, including a slowdown in inward migration since July 2017, constraints on investor finance imposed by state and federal governments, and falling home prices. And they expect that it will continue to slow over the next 2 years due to the adverse factors now starting to take effect in the market. Specifically, they say that finance has become increasingly difficult to access for home purchases. Restrictions on lending to investors and rising borrowing costs have seen credit growth squeezed. Falling house prices in metropolitan areas have also contributed to banks tightening their lending conditions, which have further constrained the availability of finance. An increase in interest rates charged by banks, which has been anticipated, will, they say, accelerate the slowdown in sales and ultimately new home building activity. Now, the latest data from the RBA and APRA confirm the fall in credit momentum, with the monthly RBA credit aggregates for July showing total credit for housing up only 0.2% in the month to $1.77 trillion, with owner-occupied credit up 0.5% to $1.18 trillion, and investment lending down 0.1% to $593 billion. Investment housing credit fell to 33.4% of the portfolio, and business credit was 32.5% of total lending. APRA's data show that investor loan balances at Westpac, CBA and ANZ were all falling in the month, while NAB grew just a tad. Macquarie, HSBC, Bendigo Bank and the Bank of Queensland grew their books, highlighting a shift towards some of the smaller lenders. Suncorp balances fell just a little too. You can watch our separate video, Rates Up, Lending Down, for more on this. And of course, we saw more out-of-cycle rate hikes from Westpac, who lifted variable rates for owner-occupiers and investors holding loans with them by 14 basis points. See our video, Westpac Blinks, for more on this, where we discuss the margin compression they experienced thanks to rising international funding rates, see the BBSW, and the switch from interest-only to principal and interest loans. Then on Friday, Suncorp and Adelaide Bank, both of whom had already lifted a couple of months back, lifted again. As I said yesterday, what is happening here is that funding costs are indeed rising, but the real story is that they're also running deep discounted rates to attract new borrowers, especially low-risk, low LVR loans, and are funding these by repricing the backbook. This is partially a story of mortgage prisoners and partially a desperate quest for any mortgage loan book growth they are able to capture. Without it, banks' profits are cactus. Once again, customer loyalty is being penalised, not rewarded. Those who can shop around now may save, but those who cannot, thanks to higher lending standards or time or a combination of both, will be forced to pay more. Damien Bowie at Credit Suisse, who was writing before Suncorp and Adelaide Bank moved again, said Westpac was the latest of the banks to hike variable rates across new and existing customers, following similar moves previously from the Bank of Queensland, Bendigo, Macquarie Bank and Suncorp over the past few months. Not only are out-of-cycle rate hikes broadening out across the system, but they also think that they will continue to broaden out across the majors and become a returning and recurring theme. This is because, firstly, money market rates are a significant driver of the marginal cost of funds, and arguably the banks that have hiked out of cycle to date have been more exposed to money markets than the banks that have not. Therefore, money market stress has had a bigger impact on their profitability, putting more pressure on them to hike rates. However, if there are question marks about why certain systemically important banks are facing liquidity or credit problems, then funding costs must inevitably rise for everyone, even if we're only talking about small but fat tail risks. Also, RBA research suggests that as rates approach the zero bound, the relative cost of no low fixed rate deposits increases to the point that, perversely, margin pressure can increase. Secondly, interbank spreads should be negligible unless, if a central bank targets a cash rate like the RBA does, it must be willing to provide any and all reserves that the banking system needs. In other words, it must be the lender of last resort. And if it is possible to obtain reserves from the RBA in almost any situation, there should be no need to borrow from each other. In turn, the spread of bank bill swap rates, the BBSW, to overnight index swap rates, the OIS, the risk-free rate, should be negligible. Unless, of course, there is counterparty credit risk over and above liquidity risk. And interestingly, the RBA has gone out of its way recently to remind the market that it is indeed the lender of last resort. But the BBSW-OIS spread remains elevated at European crisis highs of around 45 basis points. Third, wide interbank spreads are hard to explain using conventional factors. For as long as there is a pricing premium mystery, there is no visible end to the cycle of out-of-cycle rate hikes. Interestingly, in its August statement on monetary policy, the RBA provided some alternative explanations for wide interbank spreads after witnessing the US dollar liquidity narrative breakdown in recent months. But even bank officials do not find these explanations convincing. Therefore, the mystery remains unresolved. And fourthly, the marginal funding cost drives the change in the average funding cost. Therefore, we do not need to forecast further increases in the BBSW-OIS spread to have conviction that banks will continue to hike rates out of cycle. We need only to know that the BBSW-OIS spreads will persist at the wide current levels. Again, for as long as there is uncertainty about why the spread is so wide to begin with, it's hard to argue with conviction that spreads ought to narrow and normalise. Even after some banks have hiked rates out of cycle, they still think that in aggregate there are more than 50 basis points of variable rate mortgage hikes in the pipeline based on already known developments in the money market. But the RBA only has 1.5% worth of rate cut ammunition left in the bag of tricks. This means that the RBA has lost some autonomy over the monetary transmission mechanism because effective borrowing rates can rise independently of the cash rate. In particular, the Australian-US yield differentials are likely to further invert, undermining the carry trade appeal of the Aussie dollar-US dollar. The Fed still seems quite determined to hike rates, but the RBA is unlikely to be matching the Fed's hawkishness given the slowdown in train and given what the banks are doing to rates and credit supply. So, we are in for a period of more out-of-cycle rate hikes, as well as tighter lending standards. No surprise, then, that refinancing rejections are rocketing, as we reported this week, and mortgage prisoners are getting locked in. The ABC story even got picked up by Zero Hedge in the US. So now back to that 9 News report. They missed completely the real reason why home prices are falling. It's all about credit availability. Lending standards are tighter now. Borrowing power is reduced, and so new loans are only available on tighter terms. If you want to understand the link between credit and home prices, which is still not widely understood, I recommend you watch my recent conversation with Steve Keen, who explains the mechanisms involved and the policy failures behind them. See Are Icebergs Fluffy? A conversation with Steve Keen. This show has already become one of the most popular on the site, and it's really worth a watch. The upshot, though, is that home prices are likely to continue to fall. CoreLogic's dwelling price index showed another fall in August, recording a 0.38% decrease in values at the 5-city level. This is the 11th consecutive monthly decline in home values, down a cumulative 3.4% over the period at the 5-city level. Quarterly values also fell another 1.3%. In the year to August, with the home values down by 3.08% at the 5-city level, driven by Sydney, who's down 5.64%. Significantly, Perth's housing bust continues to roll on, with dwelling values now down 13% since peaking in June 2014, after falling another 0.6% in August. The cumulative loss in values at 13% is greater than the 11.5% peak to trough falls experienced around 2009. And the duration of the downturn has now hit 50 months, more than twice as long as prior downturns. Plus, rents have been falling as well, with median asking rents down 29% for both houses and units since June 2013. Now, my theory is where Perth has gone, other centres are likely to follow as the great property reset rolls on. Melbourne and Victoria is deteriorating significantly now, and remember that there, net rental yields are some of the lowest across the country. No, prices are not likely to recover anytime soon. And if you want further evidence, auction clearance rates remain in the doldrums. It's interesting to see now the mainstream media is beginning to talk about this. And I've been busy this week with interviews on Radio Melbourne, 2GB and elsewhere. Remember, this is only the end of the beginning. I continue to believe that 2019 will be a really bad year. What with more rate hikes, interest-only loan switches and decaying sentiment. As one industry insider told me this week, some of my property investor clients have decided to try and sell before the falls bite. It just, though, may be a bit too late. And to add to the mix, ABC's Michael Jander wrote an excellent piece this week on the advantage some large banks have with regard to how APRA calculates their capital base. The big four banks between them hold around 80% of all Australian home loans. There are many factors that have led to this extreme market dominance, including economies of scale, better credit ratings, and an implicit federal government guarantee, all of which are linked. But the major banks, plus Macquarie and recently ING, also enjoy a regulatory benefit that is little known outside the financial sector, but which provides a substantial competitive advantage. The CEO of ME Bank said that the average capital risk weight of the standard banks is around 39%, whilst the major banks average around 25%, and the actual cost difference of that equates around 15 basis points in margins. So it's not insignificant at all. Those 15 basis points or 0.15 percentage points either have to be added onto the interest rate of mortgages that ME Bank and other smaller lenders offer, or they take a hit in their profit margins. For regional banks on the standardised system, the safest, high deposit, fully documented housing loans are considered at just 35% at risk, meaning they only have to hold $35,000 in capital on $1 million of a home loan. However, the major banks plus Macquarie and ING are allowed to set their own risk weights using internal financial modelling under the Internal Ratings-Based or IRB approach. Until the Financial System Inquiry, the FSI, there was no floor on how low these could go, and a couple of the major banks were averaging less than 15% on mortgages, meaning that they held less than $15,000 in capital to protect against losses on $1 million of home loans. Smaller banks have disadvantage baked in. However, on recommendations from that inquiry, the bank regulator APRA introduced a floor of 25% on the average mortgage risk weight for these banks. But that still leaves a similar difference between the amount of capital the big banks hold and what the smaller banks have to put aside. APRA continues to argue that the advanced banks are more sophisticated and so deserve benefit from their investment in more advanced management systems, and yet APRA's most recent reviews suggest significant issues. Here's a recent discussion between Senator Whish-Wilson and the APRA chair, Wayne Byers, discussing in a Senate committee hearing in May the outcomes from their latest targeted reviews of major bank practices in 2017, but only released publicly through the Royal Commission process earlier this year.
The targeted reviews detail extensive problems within the Big Four regarding their mortgage books, particularly in relation to income and liability verification of customers and the collection and management of data. Do the findings of the targeted reviews accord with the requirements of a bank to have a strong and sophisticated risk management framework to use the IRB?
So they're clearly so the results are clearly not ideal. They're not, though. The issues of the targeted review are a broader subset of risk management of the portfolio, and also a broader subset of the way in which banks assess the risk of their borrowers. So it was a narrow perspective, but it's not a good report card, so I'm not complaining about that.
And in addition...
So the response to that, though, is to say that there's a range of ways you could deal with that, but essentially the way it's being dealt with at the moment is, in the case of all of the banks, they are running, because we have imposed through different means, they are running, for want of a better term, higher capital requirements than their models would naturally produce, because we have overlays and we have a raft of interventions that have pushed their risk weights up.
I met with representatives not long ago from regional banks and late last year, and one of them said to me that they'd spent in the order of about $40 million on modelling to try and get IRB authorisation themselves to no avail. And what is it about a major bank that makes their management of their mortgage book so much more sophisticated and less risky than a regional or tier 2 bank?
I think it is the investment they've made in systems, the investments they've made in risk management and portfolio analytics. That's at the heart of it. It is deliberately a high standard, because what's happening with IRB is essentially there is a default method, the standardised method, and the bank needs to demonstrate that it is producing better measures of risk and, in a sense, better quality predictors of risk than the regulator's default settings. And that does take investment.
True, but the targeted review showed that these systems are flawed, though, doesn't it?
It showed that there are certainly weaknesses in some components of it, but it is not showing necessarily, or is not showing because that's only one part of the risk management framework and the risk modelling process. Banks use a range of other things to assess the quality and probability that a borrower defaults, including the borrower's behaviour over the life of the loan. The serviceability is a point in time before the loan is granted.
This casts doubt on whether the Big Four actually live up to the theory of having better risk management and measurement processes than the smaller banks. Is APRA still captured, we ask? And should the playing field be levelled? We continue to think it should be. So now to the markets. Locally, Bendigo and Adelaide Bank fell 0.26% on Friday to 11.59. Suncorp rose 0.06% to 15.49. Westpac fell 0.38% to 28.54, well down from a year ago despite the mortgage rate hike. And CBA fell 1.26% to 71.24. More are getting negative on the banks given recent events. The ASX 200 fell 0.51% to 6,319, just off its highs as the financial sector fell away. The Aussie continues to fall against the US dollar, down a significant 0.96% to 71.93, and we continue to expect more weakness ahead. Sentiment, though, is rather different in the US markets, with the 10-year rate still elevated and the gap to the 3-month LIBOR very narrow, as we discussed before, a potential harbinger of a recession later. But the US stock markets remain in positive territory. The Dow Jones Industrial Average fell 0.09% to 25,964, still below its peak from February. The S&P 500 passed a new record in the week and ended on Friday at 2,901, and the VIX was down again, falling 4.95% to 1287, indicating that the market is risk-off at the moment. The US dollar index futures was up 0.43% to 95.05. That said, the burst of optimism about trade in the market during the week did not last, until the closing bell on Friday. The US announced a bilateral deal with Mexico on Monday, but tension built throughout the week as the US announced there was a Friday deadline to bring Canada into a newly revamped NAFTA. The US and Canada missed that deadline, but announced that talks would resume next Wednesday, leaving the market facing more wait-and-see trading days. There was also drama during Friday's discussions after the Toronto Star reported that Trump told Bloomberg off the record that he had no plans to give any concessions at all to Canada. The president appeared to later confirm that stance in a tweet. And trade worries spread beyond North America. Trump told Bloomberg that he was prepared to withdraw from the World Trade Organization if necessary, and he plans to move ahead with tariffs on $200 billion worth in Chinese imports as soon as a public comment period concludes next week. China's foreign ministry said Friday that the US putting pressure on Beijing just would not work. The yuan rose a little against the US dollar, but remains way down on a year ago. Meanwhile, retail earnings dominated the Canada this week, with strong stock market movements in the low volume environment. The S&P Retail Index ended up slightly for the week. Among big movers, Abercrombie & Fitch stock plummeted on second quarter revenue and same-store sales missing estimates. Best Buy stock tumbled despite better than expected second quarter revenue as online sales slowed, and the company warned that it is expecting a non-GAAP operating income rate decline in the third quarter. And Tiffany & Co. spiked on second quarter results and strong outlook, but then tumbled in later sessions. In tech, Tesla's shares started the week with a quick drop and finished lower as it scrapped plans to go private. CEO Musk wrote in a blog late last week that he would not move forward with a plan to take the company private, noting that after speaking with retail and institutional shareholders that the sentiment, in a nutshell, was please don't do this. Musk had surprised the market out of the blue, tweeting that he was thinking of taking the company private at $420 per share and had funding secured. The SEC was interested in whether the tweet was designed in a way to punish short sellers, according to reports. The Nasdaq rose 0.26% to 8,109.5 in record territory, driven by the booming sector. Data out this week illustrated two contrasting segments in the US economy, one stronger and one weaker. Economic indicators on the consumer side remained very strong. The Conference Board's Index of Consumer Confidence increased to 133.4 this month, compared to a reading of 126.7, which was forecast by economists. That was its highest level since October 2000. And the University of Michigan's August Consumer Confidence Index was revised up to 96.2 from its preliminary measure of 95.3. And consumer spending, which accounts for more than two-thirds of US economic activity, rose 0.4% last month, matching June's reading and analysts' forecasts. But the National Association of Realtors said that its pending home sales index, which measures signed contracts for homes where transactions have not yet closed, fell 0.7% to a reading of 106.2 after rising by a revised 1% in the previous month. An economist had forecast pending home sales rising 0.3% last month. So more questions on the housing sector remain. Oil closed out the month higher as traders balanced expectations of crude supply losses with the potential of trade wars denting global demand. China, the world's largest commodity importer, has seen economic growth dwindle since the trade war with the US kicked off, and a further escalation could dent growth, forcing Beijing to rein in crude imports. Oil prices ended the month nearly 2% higher on bets of renewed global supply shortages, as US sanctions on Iran's crude exports are expected to reduce crude from market, underpinning higher crude prices. Gold moved a little higher this week, ending up 0.16% on Friday to 1,206, and Bitcoin lifted 1.23% to 7,029. So, standing back, we can see a significant divergence between the local Australian market, dragged lower by negative sentiment on banks and housing, and the increasing realisation of more issues ahead, and the US market, where stocks are at highs despite the building risks from higher corporate debt and the yield curve inversion. If you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. The link is in the comments below. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all, and if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.